Thank you for joining Market News with Rodney Lake. This is a regular program for the GW Investment Institute, where we talk about timely market topics. I'm Rodney Lake, the director of the GW Investment Institute. Let's get started. Welcome back to Market News with Rodney Lake. I'm your host, Rodney Lake. We're coming to you from the GW School of Business right here in Foggy Bottom in Washington, D.C., George Washington School of Business, our home. So what are we going to talk about today? This episode is going to be a little bit different. We're not going to tackle a single company. We're not having a guest. We're going to do a little bit of a compilation, market news, just as we do in class sometimes. What's the reason? Well, there's so much stuff going on. We've covered a lot of the companies in the portfolio. So today I want to take a little bit of time for this episode to review a few things that are happening in the market that I think you should be paying attention to if you're an analyst, if you're watching these companies. But we don't necessarily need to go over each company with the framework. We'll talk about the framework for sure, business management, price valuation, and balance sheet. But again, this episode will be a bit of a compilation covering a few companies that are in the portfolio and in the news and things that I think as an analyst, as a business person, as an investor that you should be thinking about, you should be considering, you should be evaluating, you should be working on. So first up is Apple. So why do I want to talk about Apple? It's one of the largest positions in the portfolio for the GW Investment Institute. And again, we've covered it before, business management, price valuation, and balance sheet. It's been some time, and we'll do another episode where we cover it again. But one of the reasons I want to talk about Apple is because very recently, February 24th, 2025, so that'll date this part of it, they announced $500 billion investment in the United States over the next 4 years. So this is a pledge. It garnered a lot of news. This is a huge investment, and they're talking about doing a few key things. One of the key things, and again, this is a very substantial, maybe wouldn't call it a divergence, but alongside all these big, operations that they partner with on the outside, like Foxconn in China, bringing manufacturing back to the U.S., bringing R&D, which we'll talk about here in a second, back to the U.S. is significant. So one of the initiatives is a facility in Houston, Texas. The factory is in collaboration with Foxconn. In this case, they'll produce servers that power Apple Intelligence. So if you've been following the phones, Apple Intelligence on the 16s, and I think that's critical for people that want access to that information. They're going to have to continue to build out that infrastructure, but they're doing it here in the U.S. And that's a little bit of a divergence from how it was done in the past. Another big part of that, they're going to hire 20,000 workers as part of this effort. So that's quite significant. Another piece of this is going to be an increase in a manufacturing fund, more, chips being produced from Taiwan Semiconductor's factory in Arizona. And so these are a shift from, where things have been, which is mostly done overseas, and bringing some of that, back to the U.S. Another part of this is R&D in Detroit, so research and development. And so this is, has, to do with, the Trump tariffs that were announced and bringing things back to the U.S. So this is a very significant investment. If you're an Apple investor, I encourage you to really deep dive into this. We're just obviously covering the surface areas here, but I think these things are important. So this is a big announcement. This is a big dollar number, $500 billion over a 4-year period. You're going to get this work done in Houston around the AI servers, and that's going to help power the Apple Intelligence for the the newest phones that are out. Increase in the manufacturing fund, an increase in building out of Taiwan Semiconductor and the reliance on chips that are produced here in the U.S. And so I think, again, this is a very significant setup. And then the R&D that's happening, as I mentioned, in and around Detroit. So, and again, all this tied into what's happening with the tariffs from the Trump administration and a look to avoid that. So I think it's a big number. It's obviously going to catch people's eyes. It's going to be, something that's, interesting for people. But again, as a business person, as an analyst, and certainly we're shareholders at the Investment Institute of Apple, and it's one of our largest positions, I think we should be thinking about it. So, and again, we're not going to do a full rundown, but let's just then now talk about some of the components for Apple. So when you're talking about the business, most people know what the business here is. How does Apple make money? You have a phone, and then they sell things through the phone. So that's a huge platform. Over 1 billion users all across the world. They basically own the high end of the market, and have had a fantastic business. And the iPhone was 2007, and since then it's really been the dominant phone, certainly at the high end. And unlike some of the other competition, they build vertical as far as the phone goes, so they control the hardware and the software, the operating system, iOS. And Apple has been, let's say mixed more recently. So if you look at, okay, well, what's the market cap? 3.7 trillion. So one of the largest companies, obviously, in the world. The numbers have been okay, right? The year to date is down, but the 1 year return is up 34%. And if you look at some of the basic, changes in the business, there hasn't been much as far as changes go. But they're pouring a lot of money into these operations, so that could significantly alter the way that the business is shaped on the operational side moving forward. So again, as an analyst, as a business person, as an investor, and us as shareholders of the Institute, I think these are things you should be paying attention to. And again, why we have this episode as a compilation, I think that's a significant piece of news that you should pay attention to. And I think it's something that is catching people's eyes, but the numbers are big enough where it can make a significant difference. So if this does pan out, it's not just, we're going to put, $10 billion sounds like a lot of money, certainly for an individual. But when you talk about the scale of Apple and $3.7 trillion market cap, it's not really, but $500 billion over 4 years and getting that money to work and building out things that are certainly very important now around AI as an example, and advanced manufacturing and research and development happening back here in the US more and more. That is significant. So I think it's worth paying attention to. Certainly, Apple has its own ecosystem for its chips. It designs, but doesn't manufacture. So the A series of chips as an example. And so I think these things are worth paying attention to. And again, as an analyst, as a business person, as an investor, and certainly as a shareholder right now, I think it's important for us to pay attention to. So we may come back to Apple for the business here, but let's quickly go through the framework, but not deep dive. Management, Tim Cook, has been doing a great job, certainly negotiating with the different administrations, including the Trump administration, and keeping its eye on its global operations. I think Tim Cook has been very adept at doing this and really has been fabulous as a manager of Apple, and really has shepherded them into new heights, certainly since he has taken over. Now, there are questions, what's next? Is there a succession in place? And I think those are all valid questions to ask. Tim Cook has been in the seat for quite a long time now, but has done phenomenally well. No signs that he's needs to go or anything. But certainly, when someone's in the seat that long, you start thinking, okay, who's next? And so I think that's worth, asking. But I think they've done a very good job. That's management. And so fantastic management, of course. And so we get into the price valuation. Even though the business, and maybe one of the things that we can tackle on the business side here for Apple before we go on to the valuation here is just some of the metrics around on the margins. And so I think it's important, to talk about. So just jumping back to the business for a moment now on Apple. You're talking about revenue through December here, $395 billion, and you're talking 46% gross margin. So, $184 billion. So really exceptional margins, especially at that scale. And you look at the net margins, almost 27%. So this is a fantastic business, right? And if you look at we're going to talk about the multiple, it's certainly got re-rated over time. So when people thought, okay, they're very heavily reliant on the cycle for phones, which they were. But once the platform got built out, the ecosystem got built out, they started adding services. You talk about the ecosystem that Apple has built and keeps people in. Well, those services are cheaper to sell. So the marginal cost for delivery is lower. So that means the marginal profit is higher. And so you can have higher margins. When you get higher margins, it's sustained over time. And you also have this reoccurring cash flow. If you have subscription revenue, as an example, people are willing to pay more for that. So if you look at the multiples over time that people have been willing to pay for Apple, now this has happened over years, but certainly people have been willing to pay higher and higher multiples and assign a higher multiple for Apple over time. But if you really then look at where it is now, it's about 33 and a half times forward earnings. That's really not exceptionally high, not for a fantastic company. I think the question here and why the market, and again, insert opinion, this is entertainment purposes only, double, triple, quadruple disclaimer for all our episodes, is that possibly people are concerned about where does Apple grow from here? So if you're looking at really the revenue growth on this and you bounce back to the revenue growth side, you're thinking, oh, well, they're growing 2% a year, maybe 2.5%. How do they get to 5, 10, percent? Possible. They're going to have to unlock some other markets, possibly India, possibly this, a lower priced version that people can have access to for the higher end AI components, but maybe without the phone that they're trying to push out. So there are a variety of ways that they might get there. However, it's maybe not obvious to everyone. And if you look at the multiple, this is a possible reason why you have that multiple. So, and again, not exceptionally, bad or anything like that, or exceptionally high from if you're looking to buy shares of Apple, but certainly not, you wouldn't say it's dramatically underpriced. You certainly would say it's a great value at this price. And then you look at the balance sheet here. Well, on the balance sheet side, this is something where Apple has had a really a strong balance sheet, 141 billion in cash at year end 24, 96 billion in debt. So they are carrying quite a lot of debt, and they have actually reduced that. So if you look at from 2021, almost 137 billion, they've taken that down over time to under 100. They're at 96, but still a huge net cash position. So if you just use round numbers, let's say 40 billion in net cash right now, 141 billion and 96. So again, just kind of round numbers, 40 billion in net cash on the balance sheet. The trajectory, in which you've talked about this before for other companies, has been down over the last few years, which I think is responsible management. And the cash has obviously been in a net cash position in any case, so they could obviously eliminate that if they absolutely had to. And certainly the debt markets have been open for Apple, so not really an issue. And then the other part, which when we talk about the balance sheet, you want to know, well, okay, what are the numbers around cash flow from operations and free cash flow? So cash flow from operations at the end of 24, 108 billion. CapEx, right around 10 billion, and that's been pretty consistent over time. And obviously, that's likely to be going up from here. And then you're talking, $98 billion in free cash flow. And so again, not super concerned. And again, this is not an episode just about Apple, but wanted to talk about that $500 billion investment in the next 4 years in the US. I think that's super significant. I think you should be paying attention to that. And we may come back to Apple in this episode towards the end here, but let's move on. So what else is happening that I think, again, as an analyst, as a business person, as an investor, that you should be focused on, that you should be thinking about, that you should consider, for your time? Well, another company that we own in the portfolio, and again, we won't do a deep dive. We're covering really market news like we do in class now, is Berkshire Hathaway. So Berkshire Hathaway announced really fantastic operating earnings. Almost $48 billion in operating earnings, 25+% increase from the previous year, and a record level of cash, $334 billion in cash. And so when you look at this, they're really firing, maybe not on all cylinders, because if you sort of dig down, they're sort of uneven. So Berkshire has a bunch of operating companies, and they saw earnings declines in a little over half of those, and obviously increases in others that more than offset that. And remember, Buffett has a significant portion of companies that are public listed companies that are in the portfolio. That's why he says focus on the operating earnings, which excludes that, but does have to flow through. So if you're looking at the numbers online and you're like, that doesn't match up, that's because the overall number for earnings is going to include those mark-to-markets, which he thinks, and I agree with, that it's really not relevant looking to that quarter to quarter. You really want to look at what are the operating companies doing over time, and obviously you're looking for those businesses to improve over time that they own on the equity side. But okay, what does this mean? Well, certainly now, if you thought about Berkshire, it is a really diversified business. It has operations across a wide variety of different companies and different businesses in different industries. Obviously, insurance, energy are big ones, railroads, big ones. And so, and then the compilation, including Apple, as an investment in their portfolios, but they also have oil and gas as an example. And so, what does this mean for the economy? So if you look at Berkshire versus the economy, you certainly see, as a representation rather of the economy, you can certainly see that, if about half of their companies didn't perform well and another half did really well and more than made up for that, you're certainly seeing this uneven distribution of returns as far as, the ability for these companies to perform in this environment. And possibly that's the way that the broad market is also going to do. And the other big thing I think is worth mentioning is that the cash continues to pile up at Berkshire. And if you look at the cash pile, $334 billion, record levels, Buffett, effectively not finding, values that he likes in companies. And certainly at this scale, they have to, he calls it, having the elephant gun. At this scale, they really have to buy entire companies to put any meaningful amount of cash to work. And certainly the equity portfolio there, they are putting money to work, but you're really talking about super big numbers. And of course, Buffett's 94 years old on the management side. So that's the business. Let's duck into the management here for a second. Obviously, Buffett is the face of the company and has been for 60 years. Charlie Munger recently passed away. Certainly, rest in peace to him. But if you look at what's happening, Buffett is 94, right? How much longer is he going to run the business? He acknowledges Greg Abel as the successor. He's, in his 60s, so much younger guy, certainly than Buffett. And I think Buffett demonstrates lots of confidence in Greg Abel and has really over time in the last few years for that. Now, a question for all of us who've owned Berkshire, and certainly for the Investment Institute, and anybody that's even casually followed Berkshire Hathaway, is Berkshire Hathaway going to get the same kind of deals that Buffett got? Are they going to be able to strike these deals with these companies and take them private, or these private companies and make them part of Berkshire Hathaway? Are people going to have the same willingness with Greg Abel to do those deals? Maybe, right? And another piece, going back to the business, that things that did well, their investments in these Japanese trading companies, that has proved very successful in the way that they finance it. Basically, they're getting more in dividends than what they're paying for borrowing the money in yen. And so really match that up really well over there. And these companies have continued to do well. So really great call there. And Greg Abel was involved in that and really was sitting side by side, quite literally, on, I think it was CNBC at the time, talking about that investments when they started doing those things. So I think it's really important, and they've obviously made strides to make it super important for people to understand that Greg Abel is out there and, going back to management here. But I think it is an open question. I think it would be very difficult to say that for anyone, and some people have probably better insight, and I don't talk to Greg Abel or Buffett on a daily basis here, but I think you would have some challenge to say that Greg Abel, even if he's very effective, that's going to have the same type of opportunities presented to them as Buffett did. Now, time will tell. Because Berkshire has built this fortress, because they have this cash, because people know that they buy and hold for the long term. And if Greg Abel continues this type of mantra, this type of culture, possibly they continue to get these types of deals where people want to sell their business to Berkshire because they want to preserve it. They built it over time, and it is a home where they can take it and sell their business. And if they need to get out of the business for whatever the reason is, or it's just time for them to move on, but they don't want their business destroyed. Berkshire Hathaway is highly decentralized, continues to be highly decentralized. And so it's a place where you could sell the business to Berkshire if you're the business owner and founder and CEO, and feel good that they're going to take good, responsible care for this business and all the people that have helped grow this business over time and work there currently. So I think that's, it can happen, but I think it's an open question whether it will happen or not. And, back to, what's Buffett thinking about for the cash pile? It's been piling up, and they've been effectively net sellers of equities. And so, we'll see. So if for, what they're doing, it seems counter-cyclical to what's happening in the markets. The markets have been, year to date, I think it's a little bit more challenged, but certainly over the last year, the last 2 years, the markets have done very well. So when you look at the calendar years for last year, 24, and the year before 23, you had really remarkable years, above average returns for both of those years. And I think people are, can we have a third year for the same thing? Now, interest rates are, where the 10-year coming down a little bit. and tried to unlock the economy. And certainly tied into all this is trying to get inflation out of the system. If you look at what's happening in Doge, that's possible on the fiscal side. If you make really good reductions there, and then certainly on the monetary side, you need to do work there to get the rates down. So that can be an unlock. Now, if we move on, that's the business, that's the management. We'll see. The price valuation, certainly you wouldn't also call, Berkshire very cheap or expensive here. If you look at it on a PE basis, which is hard to do sometimes, but if you can look at it at 25 times, that's kind of a market multiple. The market cap, $1 trillion. Certainly one of the very few non-tech companies that are at that level at the $1 trillion mark. So really remarkable growth, certainly over the time for Buffett, and certainly not a super expensive valuation from here. And if you look at, Buffett would look closer to price to book, which they're not buying back shares, and they're sort of the number that they have is 1.2, and now it's around 1.6.5 times. And so that would, for a reference point at 1.2, you could certainly say that the 1.6 is much higher than that. And, as we're recording this in mid-February or later February, it's hitting a 52-week high. And so certainly people are appreciating the earnings power that this company has, that Berkshire has. They're looking past any sort of succession issue and thinking that, okay, even if it's Greg Abel today or tomorrow, that people think that he's going to do a good job and possibly get maybe similar, not the same deals as Buffett. And certainly when you talk about the balance sheet, we just mentioned the cash pile. And so certainly you're not worried about the balance sheet for Berkshire, over $300 billion in cash. And so not a concern really there. And so again, that is in the news. And we're just going to touch on one more company, and we won't spend a ton of time on this company. But another company that announced earnings recently, and we this is an investment in the portfolio and has been, is Walmart. And so Walmart, announced better than expected earnings, had a tough time right after that. But look at the year to date for 2025, you're up 7%. So when you talk about the business, I think most people know the business for Walmart. But if you read through the earnings announcement, and again, I think if you're a business person, you're an investor, you should be paying attention to Walmart. Even if you're not, directly invested, you're not a shareholder, because I think obviously it's a huge company, huge retailer, huge grocer. It touches a different, a wide swath of the economy. So on the retail side, so I think it's important to understand what they're doing and how people are also then valuing them. And look, they've grown their advertising business. So some of the higher margin business as they have grown, and the Walmart Plus. So I think they're doing a good job there, and the market's definitely giving them credit. So business-wise, again, I think people know that. I think less people probably understand that they're making strides in advertising, making strides in the Walmart Plus. Those are higher margin businesses. So I think it's important for people to pay attention to those things, those growth drivers that are outside the traditional retailing experience at Walmart. But, you get to the management. You've had fabulous management. Really no concerns on the management side there. Really fantastic here. McMillan has, I think, done a really great job at Walmart, and I think is doing a really fabulous job. Hasn't been there as long, and so versus historical, let's say, setup. But I think it is doing a fabulous job. So management, I think you can give sort of high marks to. We won't give any scores necessarily today. But then you get in, how's Walmart doing on the price valuation side? I think this is where people get a little bit concerned if you're an investor in Walmart and you're thinking like, well, let me check out this company from the valuation side, and you're paying, 36 times forward, right, for a retailer. And when we go back, if you think about the business side of Walmart, you're talking single-digit margins on the net side. So that's very challenging, I think, for an investor to say, okay, net margins 3%, not something, gross margins 25, net 3. They have a lot of work to do on those higher margin businesses to make a big difference there. But, I think it's important. I think on the balance sheet side, moving quickly to the balance sheet, not super concerned there. They have $9 billion in cash, $60 billion in debt, so certainly not as comfortable as one of the tech companies. But if you think about sort of their ability to generate cash flows, not super concerned there. And if you look at what's the interest coverage ratio, 13 times, not super comfortable, but certainly not a huge concern on the interest coverage ratio. So overall, quite good. And so those are the three companies. So when we talk about market news in class, we go over a lot of more things in a much shorter period of time, just a few minutes. But for today's episode, I just wanted to cover those three companies because they are very much in the news. They're across a few different industries. So I think it's important, tech, certainly conglomerate, and then retailer. So I think it's important as an investor, as a business person, as a shareholder in these companies, for us at the Investment Institute, it's important for us to pay attention to these things. So I encourage you to look at Apple, the $500 billion they're putting to work over the next 4 years, bringing that money back to the U.S., advanced manufacturing, AI, R&D. I think that's super important. If you look at Berkshire, obviously had done well on the operating earnings side, $1 trillion market cap, $300 billion plus in net cash, net sellers of equities, seemingly concerned about what's the valuation for companies across the market. Important to watch them. Uneven distribution of how things have turned out there as far as the operating companies. Some, half have done well, half have not, approximately, let's say, but more than half have done more than made up and had a very good picture on the operating earnings side. Continue, again, to increase that cash pile, so seem to be concerned. Walmart did very well. Don't bet against the U.S. consumer, has held up. They did sell off after that, but the metrics look good. If you look at the non-sort of retail businesses that are growing around advertising and the Walmart Plus, obviously connected there are higher margin businesses, things to be excited about there. But again, these are three companies, behemoths, all of them. You should be looking at them. You should be checking them out. You should be trying to understand them. And again, as an investor, as a business person, as a shareholder in these companies, for us, we want to take time. We want to make sure we have a good view on what's happening. And I think if you look at these three companies, you're getting a broad section of what's happening out there in the economy. And I think that can give you some insight into what's going on and form your opinions for other companies as well. So that's it for this episode. I encourage you to keep on investing, keep on doing your research. We look forward to seeing you back on the next episode of Market News with Rodney Lake. Thank you. Disclaimer, the content shared in the GW Investment Institute podcast is for informational and educational purposes only and should not be considered investment advice. The opinions expressed in this podcast are those of the host and guest and do not necessarily reflect the views of the GW Investment Institute or the George Washington University. Listeners should not act upon the information provided without seeking professional advice from a qualified financial advisor. Investing involves risks, including the loss of principal. The GW Investment Institute, the George Washington University, and the podcast hosts do not assume any responsibility for any investment decisions made based on the content of this podcast. Always conduct your own research and consult with a financial advisor before making any investment decisions.